Revenue and Customs has initiated a massive wave of tax and customs reforms, with major structural changes to go live between 2026 and 2029. Navigating this shift involves mastering the structural mechanics of the reforms, rather than just learning the latest accounting terminology. This architectural shift represents a transition toward a system structurally hardening against traditional compliance practices. The first pillar, simplification, includes policies explicitly designed to remove administrative deadweight loss for legitimate trade and innovators. A primary example is the update to corporation tax quarterly installment payments, or QIPs, arriving in April 2027. Currently, augmented profit calculations penalize innovators by counting R&D and creative expenditure credits as profit. From April 2027, R&D and audiovisual credits are explicitly discounted from these thresholds, ensuring companies aren't brought into the QIP regime solely because they received these credits. This definitional change is designed to ease cash flow pressures and ensure the tax system doesn't accidentally punish the businesses it aims to support. Simplification is also moving into the management of private wealth and reporting easements. Starting April 6, 2027, the government will remove inheritance tax reporting requirements for certain non-tax-paying trusts where no tax is actually due. Finally, the government is regularizing national insurance easements to attract and retain internationally mobile talent. Non-resident directors attending a small number of UK board meetings will no longer trigger complex national insurance liabilities, providing much-needed clarity for global employers. The true purpose of Pillar 1 is to create frictionless fast lanes for capital, freeing up HMRC's limited resources to focus on higher-risk targets. Pillar 2 is the digitalization pillar, the forced transition from retroactive analog reporting to real-time interoperable digital networks. We see the scale of this shift most clearly at physical borders, where legacy paper-based systems often act as bottlenecks for international trade. On June 1, 2026, the UK introduced digital ATA carnets, aligning with 90 territories to replace paper systems for the temporary movement of goods. HMRC is also testing electronic trade documents, or ETDs, with the goal of harnessing these digital records to meet customs requirements for documentary checks. This integration is global. HMRC is currently collaborating with U.S. Customs and Border Protection to test new digital trusted trader credentials. Processing this digital data in real time requires a move beyond manual human oversight, leading to the launch of AI customs pilots. These AI tools are being developed to support caseworkers in undertaking real-time border documentary checks, streamlining border flow while maintaining strict compliance. Domestically, the digitalization shift will reach its peak in 2029 with the implementation of the national e-invoicing mandate. The government confirmed PEPL will be the core interoperability network for the system. PEPL acts as a universal translator, standardizing procurement data across different software systems, so HMRC can read every transaction in a uniform format. Even basic processes like VAT option to tax notifications are moving to digital channels by the end of 2026, removing reliance on paper forms. Pillar 2 forces businesses into an ecosystem where the digital infrastructure itself acts as a real-time auditor. Pillar 3 covers enforcement, the structural mechanisms designed to automatically penalize evasion and aggressively collect debt. This pillar is a direct response to the scale of the UK's uncollected tax debt. Each year, over £2 billion remains uncollected across 750,000 cases where taxpayers have failed to respond to multiple contact attempts. To address this, HMRC is consulting on new powers to recover debt by bypassing traditional communication channels. Under these proposals, HMRC could collect debts in regular installments directly from a taxpayer's bank account if they fail to respond to contact. Enforcement also targets parity on the high street. Currently, overseas online marketplaces can disadvantage local shops through VAT non-compliance. The government is now consulting on extending VAT online marketplace liability rules to UK-based businesses to ensure a level playing field for all retailers. This extends to physical points of sale, where till fraud remains a significant issue. New electronic sales suppression standards will mandate modern encryption and record-keeping in the EPOS sector, making it significantly harder to hide or delete sales records. Wealth management is also being secured through strict anti-circumvention rules, specifically within ISA reforms. To prevent bypassing lower cash ISA limits, the government introduces a 22% charge on interest paid on cash holdings within stocks and shares ISAs. Simultaneously, the threshold for publishing details of deliberate tax defaulters is rising to £50,000, alongside a new criminal offense for reckless, untrue statements. Pillar 3 represents a definitive shift from reactive auditing toward proactive, hard-coded financial extraction. When you view the complete architecture taking effect between now and 2029, the full strategy comes into focus. The matrix operates in tandem, providing frictionless flow for compliant entities while automatically triggering penalties or diversions for anomalies. This reveals the fundamental philosophical shift in the UK's approach. The burden of proof has moved. Verification is no longer a manual task for the taxpayer. It is being hard-coded into the digital infrastructure via PEPL, AI, and encrypted software standards. This digital integration gives HMRC an unprecedented, real-time view into the life cycle of every transaction. That visibility is what enables the aggressive, automated debt extractions and the 22